Hi and welcome to part one of the test bars, where we're going to actually look at professional buying bars, also known as demand, because the markets are driven higher by demand and they are sold on supply. Everything in business works on supply and demand, and the markets are no different. So let's have a look at the anatomy of a professional buying bar and how we can actually identify when the big money is in the markets. And the first thing, and this is one of the things that Tom didn't have when I studied with him in 1993-94. He only had the low of the bar, the high of the bar, and the close. For me, the open was really important because this was the way I could determine whether there was real, genuine demand in the market or not. And without the open, in my opinion, you couldn't see whether if the market had opened up here, then we had a completely different thing that was going on. So, the market opens at this level, moves lower, and then comes back. It's completely different to what you see here. You've got the market opening, prices drive higher, and then they close on or near the highs. And the volume, which obviously is what shows the demand, is greater than the average for X number of bars or days. What I was able to do by actually including the open in the price bar, because it's a very difficult concept now to actually understand and think that we never actually had the open back in the 1990s. The sort of revolutionary change in trading now is just, it's day and night. I mean, we had to phone the orders through. I was at an account with the brokers in California, and I used to phone California, put the orders on. I never saw a single thing, and now people are glued to the screens. Yet in those days, you'd think nothing of just carrying on with your life. You didn't have mobile phones to check prices, nothing. You just put the trade on and you carried on as normal. And normal for me in those days was studying the markets and subjects like this. But it's amazing how different things are now. I know I'm digressing here, but I mean, it really is day and night. And this is because I wasn't glued to the screen. I was able to step back and have a look and see how things actually worked. And this is where I came up with the concept of, well, surely the open is as important as the close. But because this wasn't available, or only just became available in the early 90s, I was able to implement that into the way I actually looked at observing and interpreting demand in the market. So professional buying bars, again, just to return to the subject, the market opens, prices drive higher, they close on or near the highs, and the volume is above average. Simple as that. And inside of the software, you will see this represented. There are three types of professional buying bars, but we don't need to understand all of these because the software highlights all of them and they all mean the same thing. But I did notice that you would get days when markets would gap and drive and this sort of thing, but we don't need to really understand all of that in order to get the trading edge that we're looking for in the market. So here you can see that we've got a definite uptrend. Prices are moving higher, and when prices are moving higher, you will get professional money coming into the market and driving prices higher. And you can see all of the green volume bars. If you then look at the corresponding price action, you will see that prices are being driven higher as this volume comes into the market and drives prices higher. So in an uptrend, in a bull market, professional buying bars are driving the market. It is buying, it's predominantly buying that's driving prices to the upside. However, in a down move, you can get a situation where you will see the price bars like here and here, and then prices following actually move lower. So what's going on here, and also this one at the top? Well, the answer to that is very, very simple. It did take me a while to actually work out what was happening. But if you are a seller of the market, you actually go short. You sell something to somebody to buy it back in the future. And again, this is where the smart money comes in. So as the market moves lower here, let me just remove these arrows and redraw them. As the market's moving lower, you will see all of a sudden you get these buying bars, and the same here after the markets move lower as well. And what's happening here is very, very simple. When you sell contracts into the market, as you would with Bitcoin futures contracts or corn or S&Ps, whatever it is that you're selling, if you're trading and not spread betting, but actually selling the futures contract onto the market, which is what the big boys do. They don't spread bet or do CFDs. They do serious stuff like futures contracts and options. So what's going on here is that because you've sold, you have to buy back the contract. So what happens is, you've got profits trading down to here, you're short, you've sold the contract, and you have to buy it back. And this buying back of the contract is why you see professional buying bars do this, and then the market continue lower after it. It's a period of profit taking in the down move. It's as simple as that. But when you first see it, you say, well, surely the market should go up from this point. Well, the answer to that question is not necessarily. If you understand what the background of the market is, if you've got a down move in progress in a market, then you'll get these bounces, and these bounces you will see this professional buying, and then the market resume in the direction of which it was trading. And that's why it's important to understand the background of the market. Again, you don't have to worry about this because I will show you this in the market alerts. But it's important to understand why when you first look at something, you go, well, surely the market's going to go up now. We've got the buying in. Not necessarily. You will get what's called a climatic action, price action, where there'll be a fight between the bulls and the bears, and then the market will flush out all of the bears. I'll make sure there's no more selling, and then the market will move higher. And we'll look at that as we go forward in section 4 when we look at potential strength. So here you've got this situation where the market has buying in an up move, where the buying will continue and you'll get some weakness, but then the market will eventually resume and continue higher. And then in a down move, you will get profit taking, as you've just seen here. So let's have a look at some examples in some price charts of this in action. So I'm in the software, and the first thing to do is to see how we actually put the trading edge strategy bars onto the chart. You'll find those under the indicator panel. We've got test bars here, you'll see that there, and then you want to check if you select this button, then it will select all of the trading edge bars. But what I'm going to do is to isolate this by just selecting the top 3 for this video. We'll look at videos, build them up, and keep adding them onto the chart. So we'll just start off with the professional buying bars at the moment, and then I'll left click on apply, and you will see these have been added to the price chart, and you'll see them in green. There's one there, and you can see the volume is massive. So we know the big boys are in, and if you've watched the videos on pivot points, you'll know it's this type of price action that is required to drive through these areas, and you'll see this here at the DP level. Now we know that the trend is moving to the upside as well, because following this the market trades sideways, holds at the close of the pivots, and then it drives higher through the DP and the moving average there and trades sideways. So you can see how important this demand is in the market. It takes the big boys coming in to drive the prices higher, not only through all of the pivot points, but just to take it out of the sideways move that the market's actually in. Without any of this information and not knowing this, you wonder why the market does what it does. But as soon as you're exposed to this and you understand it, you'll know exactly why it's doing what it's actually doing. So the market's moved higher through these resistance areas after the market's gone through a period of congestion and consolidation where it's just traded sideways before then moving higher. And then of course what we see is the trend change here. The market in this case puts in the fade, and if you want to know what the fade is, see the video on pivot points. The market comes back, and we trade sideways before we see it start again. We get the professional buying coming into the markets, driving up to the pivot points, and then driving up through to the pivot points once again. So now there's no mystery. We're actually seeing the market do what it should do. And again, through the DP areas, once the market has driven through these and the trend has changed, we can see how easy it is to see where the market is going to trade. So the market continues to move higher here. Let me just see if I can just bring this over a bit. And we get another one where it attempts to move higher. There's no follow through, and we see the market move to the downside. The trend has changed. The market's through the DP areas, and once it's below the DP, we know it's to the bearish side. And then we'll see the market continue all the way down. We see some profit taking here. We know it's profit taking because the market closes one back below the DP area, and there's no follow through to the upside. So we know this is profit taking. We've just come off a big move to the downside as well. And you'll also see one here as well. You've got profit taking there before the market resumes. And also because it's below, I just drag this back, below the DP area as well. So you can see where these fit in to the market phases and cycles. So the market comes all the way back down. We see some profit taking here. The market then is trading sideways. So then we see some new buying coming into the market here as it attempts to go up towards the DP level, and then overnight, which is the shaded grey area, that prices fail, the buying disappears, and then the market comes back in and sells. We see some profit taking on the short side here, and we know it's profit taking because we don't get the follow through to the upside or a close up of the DP, and the market trades sideways. And we get a false breakout here, which we've seen in the pivot section as well. The market trades sideways before moving back to the downside. We see the profit taking here at the R1 level, and the market's been sideways ever since. So by just having the one professional bar on the, or test bar on the price chart, understanding and in combination with the pivot points, we can see whether we're going to get a continuation, a breakout, genuine breakout, because there will be a move in the background to the downside if it's profit taking by the shorts buying back their contracts, or if it's genuine buying, as we saw in the earlier part when we looked at these charts, that we will see the markets driving to the upside. And of course those professional bars will be above the DP levels. If the professional bars are below, it's likely 9 times out of 10 to be bearish. We do have this one here where the market actually traded above the DP, but then there was no follow through. It just traded sideways on low volume, no more demand, and then the market had its shakeout before trading sideways and then profit taking again because the price bars are below the DP level. And when it's the other side, as we saw earlier, above the DP, then we're going to see markets drive to the upside. So combining the two things there, and there's a lot more you can combine with this, like short-term moving averages, trend lines, Fibonacci retracements as well. Once you combine all of these things, it removes the mystery from the markets. So let's move on to the second part, which is potential weakness. And potential weakness is where the market moves higher, and then you get potential weakness, but it doesn't sell off. It then moves higher thereafter. So let's have a look how we identify the potential weakness, where there can be profit taking in the up move before the market then resumes its upward trend. And the other thing as well to keep in mind in this, which we'll look again in another video, is how to determine whether the market is in a bull or bear market in the daily chart, the weekly chart, the monthly chart, so you know where you are, and you'll know with this information, this additional information, that the best side of the market to be in and the best trades to take on an intraday basis as well. Okay, that's it for this video. Let's move on and have a look at potential weakness. And with that, as ever, thanks for watching. I will see you in the next one.